Some of you have heard about it, some of you haven't. Many of you have not heard behind the scenes how this whole thing comes together. We're going to bring velocity banking together with HELOCs, home equity lines of credit.
The velocity banking strategy is an extreme debt reduction strategy that people use to become debt-free extremely quickly.
What's going on, everybody? Chris Naugle back with the Money School podcast, the podcast that teaches you how to take back control of your money by showing you how to be the bank. Today's guest is actually from the bank, which is kind of odd, right? We teach people how to not use traditional banks, but today we're actually going to take a little bit of a trip down Bank Alley, and we're going to talk about a very unique concept. Some of you have heard about it, some of you haven't. Many of you have not heard behind the scenes how this whole thing comes together. So essentially what we're going to do today is we're going to bring velocity banking together with HELOCs, home equity lines of credit. But we're going to do it in a unique way. Actually, we're not going to. My guest, Anthony, is going to, and he's going to show you how first lien HELOCs are literally sweeping the nation, and they're probably going to be something you need to learn about. Anthony, welcome to the show.
Thank you so much, Chris. I'm really excited to chat with you today and anyone else that's here that would like to listen and learn about this. I'm really excited about this. I mean, it's all that I do. So by default, kind of naturally I'm excited, but I am really excited about this product. It's a first lien HELOC. And it's growing in popularity and in awareness. I work for the bank. You're right. I work for a bank called First Savings Bank. I'm the sales manager of our branch here. And we specialize in first lien HELOCs. As a matter of fact, that's all that we do. We don't just specialize in it. We solely work with first lien HELOCs, and we help people understand what it is. We're going to help people understand how they work. We help teach the velocity banking strategy hand in hand with a website called firstlienheloc.com. And we have a specific loan product that's built for that strategy. So yeah, you're right. Although I work for the bank, I'm not anti-bank, but I am. But we do take sort of not anti, but we're competition for the amortized mortgage, if that makes sense. And so the outcomes that we see with our clients are pretty amazing. One sort of catchphrase that we use is pay off your home in 5 to 7 years. When people do that, they can save tons and tons of money. So the velocity banking strategy is an extreme debt reduction strategy that people use to become debt-free extremely quickly, and in turn save a lot of money.
Well, here's kind of, I thought about this a lot before doing this podcast, and I was thinking, all right, what are the main things my audience might want to know? And I think if I'm going to lay them out, here's what the audience, I have to believe, would like to know. What is the difference between a first lien HELOC, what your bank does, and a regular home equity line of credit that somebody would go out to any bank and get? Number two, I'd like to know, now that you added this, why your bank chose to literally be a specialist in this one thing, which is very unique. And I love that, because in specialty comes extreme knowledge. And I know you guys have that. And the other thing is, how does somebody build a foolproof system, a velocity banking system that basically can't fail if they do what they're supposed to do? So those are some of the main objectives I'd like to really hit on in wherever you'd like to start. But I think a lot of people that are listening to this, they know, what a mortgage is. Oh, I'm sorry. Well, let me add one thing. They know what a mortgage is, but they don't know that they're actually getting robbed, not literally, but getting robbed from an interest rate standpoint because of the way the amortization schedules work on traditional mortgages. Now, I know there's a lot of people watching like, Chris, no, my mortgage is only 2.75 or 3%, but I'd like you to explain from the bank side how their interest rate really is not 2.75 or 3%, and how much more they're really paying because of the velocity of interest that's being charged.
So you gave me a number of things. I didn't write them down, Chris, so bear with me if I need a quick reminder. But I'll start with the fact that people focus on the interest rate. One thing that people do is they refinance into a new mortgage multiple times throughout their life. Sometimes they do it because they move houses. Sometimes they do it because their loan officer calls and says, hey, I can offer you a 1.5% lower rate. It'll reduce your monthly payment. Sometimes they do it for a cash out refinance. So they restart their amortized mortgage multiple times throughout their whole life, which I don't know if you've looked at the amortization schedule and the ratio of interest to principal when that happens.
Oh, I have.
So
I don't think they have.
So if you haven't, you might want to pull up a diagram where it talks about or shows the amortization schedule, because at the beginning of it, the majority of the payment by far goes to the interest and the least amount goes to you, to the principal. And so every time you reset that amortization schedule, you're essentially starting back over again. It's this continual loop where you continuously start over and give the bank the majority of the money. And then you refinance because your loan officer calls and says, hey, I can offer you a lower rate. So you restart and give the bank the majority of the money. And then you move to a bigger house and you get a new amortization schedule and you give the bank the majority of the money. Most people will not actually pay off their home until the very, very last mortgage they ever have. So we're talking 50 years of giving the bank the majority of the money. And what they've done is they've convinced people to be happy doing that because you have a nice looking rate on paper. They've convinced us to be happy giving us the majority of money.
Yeah, I looked at it, and I looked at several mortgages, my own included. And what I found is that most of the mortgages that I looked at or the amortization schedules that I ran on bankrate.com, all of them in the first 7 years, you were giving 60 to as much as 80+% of every mortgage payment to the bank in interest, which means for the first 7 years, you're literally paying hardly any principal back. So the only way somebody can get ahead in a house if they take a mortgage out is if the house appreciates in value. But what if housing goes down in value, which is what we're starting to see happen right now? Houses are actually losing value. So all these people that bought at the top of the market, like, they're upside down now. How much further is that going to go? Because every payment they're making on their mortgage payment isn't really doing anything to buy down principal.
It's not doing much at all to buy down principal. And it does it with such a small amount each month because the balance is so high. So you have a fixed payment with the amortization schedule. When your balance is higher, you pay more in interest because it's based on the balance. Well, because there's a fixed payment, that only leaves a very small amount at the beginning to go toward principal, which means you also pay down the home really, really, really slowly during those first years. The first 7 years that's a good amount to kind of look at because you don't start really making headway until then. You don't really flip the switch to you're paying down more principal until 13 to 17 years. So it takes you 13 to 17 years to actually to have your payment pay more to you than it does to the bank. Well, guess what? Most people, and if we're looking at averages, most people have refinanced once or twice within that period anyway. And again, that just goes back to this cycle of the banks, the mortgage industry, we'll call it, has convinced us to be happy, giving them the majority of the payment. So
it's just, to me, I mean, every time I think about this, it just pisses me off. It's funny. My wife just recently was like, you got to do another YouTube video showing people. She said, this is ridiculous. She was talking to one of her friends, I don't know, at the meeting they were at. And her friend was like bragging that she's at a low interest rate. And Larissa said to her, she said, you're at a low interest rate, but you're still paying a lot of interest. And They didn't understand that. So she explained it and she had them look at their amortization schedule. But the thing I'm getting to here is it seems like false advertising. I mean, banks are so fast to advertise these low teaser rates, especially when rates were historically low. Every bank was advertising, 2.99 30-year fixed, 3.75 30-year fixed. And people were lining up for these things. And then when they got into the mortgage or the refinance, they barely look at all the closing costs. Banks, dude, the closing cost on a mortgage is ridiculous.
It's really expensive.
On top of the fact that none of the money that you're paying, I mean, the only thing a low interest rate does is reduce the monthly payment, but it does nothing else. And these people are just, they're upside down in these houses because of the fees and the fact of how the amortization schedule works. Why don't banks or mortgage brokers have to tell the clients that this is what it is, or do they?
So they have to disclose it. The amortization, when you get an amortized mortgage, you have a LE, and you have a closing disclosure, right? You have two different disclosures, one at the beginning and one at the end. At the end, they're required to show you the amortization schedule. It's on there. They're required to disclose it. However, I've heard of loan officers at the closing table say things like, don't look at that. It's so expensive, you don't even want to see it. So they flip past the amortization schedule because we don't want to focus on that. And I think what we've decided, or what people have come to the reality of, or that they think is true, is that this is the only way we can become a homeowner. And paying all this interest, buying a house for the bank and buying a house for myself is okay. And I'm okay with that because that's the only way we can do it. So it's like a necessary evil that people have just accepted, and they just ignore the amortization schedule altogether, and they ignore the amount of dollars they're giving the bank. And the only thing they have to fall back on is to be proud about a rate. They brag about the interest rate that's on paper, right? That's where we flip the script a little bit. That's where we focus on what we believe is important, which is how many dollars are you giving the bank? How many of your hard-earned dollars are you giving the bank to be able to buy a house? Are you buying enough so the bank could buy a house and you buy a house? Are you giving the bank more money than what it's going to cost for you to buy your house? Or are you keeping your hard-earned money in your pocket, and are you giving them the amount of interest that you believe is acceptable, right? Or the least amount possible to help your future? And so what our product does and what our strategy does is, when it works, there may be a higher interest rate on paper. But I don't worry about that, because when it works, people are saving tons. I'm talking tens to hundreds of thousands of dollars in overall interest, even with a high interest rate. And we have to help people kind of understand and work with that. But what we do is we change the focus. We focus on the hard truth, which is that with an amortized mortgage, you will give the bank a ton of money in overall interest costs. The question we ask is, can we help you save money with this strategy? And when it works, we do. And that's one thing that I love about this, because it just comes down to math, right? It just comes down to math and a simple strategy, and just using a different mortgage product that just follows different rules. And so that, to me, is why I'm excited to share this with anyone that wants to learn about it, because it's a viable mortgage product with a strategy that's extremely effective and can help people save tons of money in overall interest. And yeah, there may be a higher interest rate on paper, but you can focus on that. And for people that want to focus, or even fixate, we'll call it, on the rate, right? Then maybe this doesn't work. Maybe this wouldn't work for you, right? If you're going to choose a low rate over a much lower cost, then maybe this wouldn't work. But we focus on the overall cost, and we focus on helping people save tons of money. So yeah, that's kind of where our direction, the way we like to go, and the value that this product can bring to people.
I think it's weird because, like, if you just said to somebody, and you just, if I did this on a webinar and I said, hey, who on here would rather have a 5% mortgage or an 8% first lien HELOC? And I just left it at that. 100% would probably say the 5% mortgage. But then if I told them, how many of you would prefer to still keep that 5% mortgage if I told you the 5% mortgage was going to cost you a lot more money? I bet you a lot of people would still do it, because in their mind, they're only focused on a number. And then if you show them the math, then you'd convert them. But that's the whole thing. This is more of a lesson in education on how mathematics works, instead of just these fancy advertised low intro rates, or these, whatever you call them, teaser rates on mortgages.
Carrots. I call them carrots, teaser rates. I run an exercise with people where I'll show them the overall cost of the first lien HELOC. And a lot of times every time when it works, it's substantially less expensive than their current mortgage.
Wow.
And I initially thought that people would be really excited about that. But what I realized is people don't look at the overall cost. And so there were people that would still focus on this rate that's on paper while looking at an overall cost that's going to save them $100,000, just because they didn't realize it. And you're right. We are conditioned to do that. We're conditioned to look at the rate, because the rate is the most important factor with an amortized mortgage. That's the kind of home loan that we know about, right? So people aren't wrong to feel that way, right? But when we're talking about a different strategy, a different type of home loan, right, that can save you tons of money, my job and our job is to help people focus on the right thing, to focus on the dollars that are leaving your pocket, going to the bank. How many of those can we keep in your pocket? You know, and so that is something that we have to overcome a good bit, is this rate conversation, because that's the main one you should have with an amortized mortgage. No question about that. You should have that conversation, because the other two factors that matter, the time and your balance, are controlled by the amortization schedule. It's not really worth analyzing the amount of time you're paying interest, and it's not really worth analyzing or trying to manipulate the balance with the amortization schedule, because the schedule controls that. Well, those two factors matter. Those are the factors that we attack. We attack the balance, and we attack the amount of time that you're paying interest. So in that scenario, if there's a home loan that does happen to have a higher interest rate, but you can pay it off right away, and you arrive at a really low balance, that would mean that the rate wouldn't really matter as much. Well, that's exactly what we do. We focus on the payoff time. We focus on creating a low balance extremely quickly. It's about balance manipulation. And that's kind of where the whole strategy comes in, right?
100%. Well, I'm going to pause a couple of those other questions, but let's first, because I don't want to go too deep down those rabbit holes, I want to kind of explain the strategy. Can you walk through at the simplest level for this audience and explain how does this whole thing work from velocity banking to first lien HELOC? And then how and why would someone want to change from their traditional 30-year mortgage, which is probably at a really low rate, to go to a higher interest rate and do this versus what they've been taught to do?
Absolutely. So we can start with, what is a first lien HELOC? Well, a first lien HELOC is different than the regular HELOC that we're used to talking about, which is a second lien HELOC. So a second lien HELOC, the one that we're familiar with, is a loan product where you have your existing mortgage and you open a line of credit on top of your mortgage. The reason why it's called a second lien HELOC is because it gets paid off second if the person defaults. And so that's the reason why it's called a second lien HELOC. But in terms of how I tend to visualize it, you have a mortgage and you open a second lien HELOC on top of your mortgage, and you have access to those funds. A lot of people get those for home rehabs or to, I don't know, buy an RV or pay for a kid's college, or just to have access to an emergency fund. A first lien HELOC is different than that. A first lien HELOC, I guess by definition, is in the first lien position. So that means there can't be another mortgage in the first lien position. So it actually comes in and pays off your mortgage. It's a refinance. So it pays off your mortgage, and it assumes the balance that your mortgage has. And so I'll just throw out some numbers. If someone owes $250,000 on their house and they get a $350,000 HELOC, that would mean the limit would be $350,000. That would mean that the balance on that HELOC would be $250,000 because it paid off the mortgage. And you'd also have access to that additional $100,000 from $250,000 up to $350,000. So essentially, it's still a HELOC, but by definition, it's in the first lien position. So it actually refinances you out of your mortgage. So you don't have a mortgage; you just have one big HELOC. In terms of how people are using it, the velocity banking strategy, it's simply the most effective way to treat a first lien HELOC when you have it, for debt reduction, for interest savings. So there are two main differences that a first lien HELOC has. Now we're going to compare it to an amortized mortgage. Two main differences we have to know and understand, because these are the differences that we use to leverage the structure of this loan to make it as efficient as possible. So one is that one has to do with money flow, and the other one has to do with interest calculation. So money flow, your amortized mortgage is a closed-ended loan. So what that means is when money goes into it, it's locked away. You can never take the money back out. That's just how they work. It's just one of the rules that it follows. The first lien HELOC, in terms of money flow, it's called an open-ended loan. So money can flow in and out freely. So everything that you put in here, right, you can also take back out. So what that means is every dollar you put in the first lien HELOC pays down principal. So what that means is you could safely take as little or as much, or you could actually safely take everything if you wanted to and put it toward your house. You could do that safely because you can take it back out if you need it, right? That's one reality that we have to understand, because that's what makes this whole strategy feasible. The other main difference has to do with interest calculation. So the way that your amortized mortgage calculates the interest each month is it just looks at the previous month's end balance on that date, and it uses that balance against your rate to calculate your payment. And that's just how they do it. The first lien HELOC, or the right first lien HELOC, the compliance guys at the bank were very clear that I needed to say the right first lien HELOC, because I don't actually know if they all do this, but the right one for the strategy is going to calculate the interest payment using the average daily principal balance. So what that means is it's going to take the average of all the balances throughout the month. So this is not the best diagram, but if each one of my fingers is a day of the month, right? If all the balances are higher, it takes the average of a higher average balance, which results in a higher payment. If the average balance of all those days' balances is lower throughout the month, then it results in a lower average balance, lower interest payment. However, if we want to create the lowest payment possible, we need to create the lowest average balance. So out of all those days, the most number of those days needs to be as low, as complete as possible to create the lowest average balance and the lowest interest payment. So the way we do that, the way we create the most number of days with the lowest balance, is we need to create the lowest balance as fast as possible. I don't want my balance higher for 4 days. I want my balance as low as it can possibly be today. So we start by creating the lowest balance as fast as we can. Well, how do we do that? Well, everything we have needs to go in there as fast as possible. Understanding that naturally just leads into the first part of the strategy, which is anytime you receive money, anytime you get paid, you don't deposit your money into a checking account. You deposit into the HELOC. That creates the lowest balance possible because everything you have is driven toward that. That creates that starts the beginning of the most days with the lowest balance and therefore the lowest interest payment. So you drive in all of your income that you make. So you get paid, direct deposit to the HELOC, go directly into the HELOC, creates the lowest balance possible. That sounds pretty crazy to most people, because if we're just talking about a mortgage, if I drive in all of my income into an amortized mortgage, remember the money's locked away and I need to eat food. I need to pay for my bills and cover my expenses. Well, if all the money's locked away, you can't take it back out to pay for those things. Well, remember the first lien HELOC is open-ended. Money can go in and out freely. And so that's exactly what you do. You pull from this to pay your bills. Well, that does increase your balance. That takes away from that principal reduction you created with all your income. So if we think about 1 month cycle in terms of this strategy, you drive in all of the income that creates the lowest balance possible. Then you pull from this to pay your bills throughout the month, and that increases your balance. So at the end of the month, everything from every dollar from your income that you haven't used is still in there. Every single dollar of your surplus is simply still sitting in the HELOC, which means that the only thing that ever pays off your house are the dollars you don't spend. I can spin that in a little different way to make it sound better for my purposes, which is what that also means is every single dollar of your surplus is dedicated toward paying down the principal balance. And so because there's no money anywhere else and everything is here, there's no faster way to reduce debt. This is the fastest way to do it, which is where the name velocity banking comes in. It uses everything to maximize the dollars that you have to your benefit to pay down the home as quickly as possible. And when it works, people are paying off their home extremely quickly. And so I know you asked me for a quick explanation. That was really good. 30-second elevator pitch, but that's what it is. All the money goes in, you use it to pay your bills, and everything left over is what pays down the house.
Your real estate business lives and dies by the network and the connections that you make. I mean, after all, your network, well, it's your net worth. That's what you always heard, right? If that's an area where you desire improvement, well, Private Money Club, it's for you. PMC saves you precious time and money by bringing the real estate world, well, right to you. right in the palm of your hand. So get in on the action like so many others have by going to privatemoneyclub.com and sign up.
Where could this fail? Like, where could this go wrong for someone?
Oh, that's a great question. So if we think about the strategy, your money goes in and money comes out. And the surplus is the only thing that pays off the house. That's it, right? So if there's a household that is really tight in their budget, if there's a household who is really struggling trying to make their payments, that would mean that there's very little surplus. This won't work for them, right? If there's someone who happens to, right now, they happen to live below their means a good bit, but they're not extremely regimented or disciplined, we'll call it, right? With that, you could easily overspend, and no one's going to slap your hand, right? If we think about just some easy math for someone that owes, they owe that $250 on their house, and let's say they bring in $10,000 a month. They bring in $10,000 and they spend $7,000, right? Goes down from $250 to $240. Well, then they spend $7,000 for their lifestyle, which brings them up to $247. They would still have $3,000 of surplus in the HELOC. So what we would say is you paid down the home by $3,000 that month. Let's say that same household, they spend $8,000 the next month, right? Well, down by 10 with your income, up by 8. Well, now they have $2,000, right? Well, let's just say they overspend one month and they spend $11,000. So with this strategy, they drive in the income, which reduces the balance by $10,000. Well, this household, for whatever reason, spends $11,000. Well, they reduce the balance by $10,000 with their income, but then their expenses, they pull out $11,000. At the end of that month, their balance would be $1,000 more than where they started. Their balance would have gone up on their house because they spent more than what they made. That's a key understanding and key sort of tenet for us to understand, is that this works extremely well for people who are disciplined with their finances, who make more money than they spend, and they can do that consistently. It rewards discipline. It rewards financial discipline and financial best practice, right? But it won't fix a scenario where we're month to month, or where we're really tight in our budget. And I want to be clear that there's nothing wrong with households when they live that way, right? I think there can be a lot of embarrassment or, shame or perception that someone's, shaming you into something. That's not it at all. For me, it's just mathematics. And what I want people to do is, I want for people to choose this when it's going to improve their lives. And I don't want them to choose it when it won't. So for me, the whole purpose of kind of naming who this works for is to help your viewers understand and better align themselves with when this does work and when it doesn't. At the same time, the very fact that if someone spent more than they made, the balance on their mortgage would go up. That would be a dangerous move, right? And so our goal here is to introduce this and help people get it when it will improve their lives. And so, there was a point where I had, I've been working with this for probably 6.5 years now, specifically. I didn't have one for a while. And that was a point in my life where I had 3 kids and I was paying for daycare for all of them. It was like $4,500 that was just gone. I didn't make more money than I spent. And that was my reality. And it wasn't because I was, it wasn't because I was irresponsible. It was just a season of life. And so I just want people to know that, in terms of figuring out who this works for, it does benefit people who are disciplined with their finances, but if someone's going to manage this in a way that is going to result in a higher balance, it can turn into something that wouldn't be beneficial for them.
That's a great answer. Now, here's one thing, if I take out a mortgage from a bank and my house goes up significantly, as if we'll just use the last 5 years. Somebody took a mortgage out, maybe they paid 300,000 for a house. Now their house is worth 600,000, but like, if they wanted to take or get access to that 300,000 in equity in a traditional mortgage, it's a refinance, which restarts that amortization clock, which also results in lots of closing costs and additional revenue that, pays commissions and everything else. Now with the first lien HELOC, let's say that exact same scenario happened. You bought a house, 300,000, you did a first lien HELOC, house went up to 600. What would be required to get the bump up in available cash? How would I
that's a great question. So, so it would look like a refinance. At First Savings Bank, for any first lien HELOC customer that we have, we always waive the bank origination fees. And so there are basically 4 categories of closing costs. You've got the bank fee, you've got the appraisal, you've got the title fees, and then you've got the state fees. The last 3 are third-party fees that we don't control. But we do control the bank fee. So you would pay closing costs. It would look like a refinance. But the main difference between this scenario in terms of getting access to the additional equity in the home when your home increases in value is that with a cash out refinance, in order for you to gain access to that money, you have to pay for the full balance that you have access to, regardless of whether you use it or not. With a first lien HELOC, you'd pay some third-party closing costs to get it done. It looked like a refinance, but you'd be able to increase your line amount, but your balance wouldn't increase, so you wouldn't be paying additional interest on having access to the higher amount. You would still be paying interest on the same amount that you would otherwise. You just have a much higher line and access to a much higher amount.
That's a good point. Yeah. So if somebody does a cash out refi, they're paying a mortgage payment on the full amount. And then chances are a lot of that refinance, that cash out, just goes into a bank, probably the same damn bank, and just sits there making 0 to, if they're lucky, 2% right now.
That's right. 0 to 2 or 3% on a high interest, high yield savings account. So what a lot of people like to do is you define that available line at the most basic level as an emergency fund, right? So you have $100,000, $200,000, $300,000, $400,000 in an emergency fund that you're not paying interest on, but you have access to it. Now we can add in other layers. If you're a real estate investor, now you can become your own, I was going to say bank, but that's not my phrase. But you can replace the bank's function in terms of purchasing a home, right? You can be a cash buyer because you have access to the money immediately. You can be your own hard money lender because now you can fund your own rehab. And then now you're borrowing from the HELOC to purchase the home and refinance the home and rehab the home, Once the flip is done, if this is a flip and you sell, now you take all of the money that you borrowed, you put it back on the HELOC and all the profit that you made from it as well, and go right back on the HELOC as well, paying it down even faster. So that's one route. If we're talking about a BRRRR strategy, do the same thing. You purchase it with the HELOC, you do the rehab. Part of the BRRRR strategy is after your 6 months on title, if that's the type of bank that you're working with, you do a cash out refinance to then get the money back in, and now it's liquid. We store the money in the HELOC until your next deal. And so there's the pay off your home really quickly, save a ton of money on interest costs. Now, those things are very real realities for people when they get this. That's our initial introduction because that's what the velocity banking strategy is all about in terms of outcome. However, that's not the only thing that you have to do with this. Excuse me. Paying off your home really quickly isn't the be-all, end-all goal. It is one, and it's an amazing one to accomplish. But there's this other piece to it too, which is now we have access to $100,000, $200,000, $300,000 in equity. If you want to use it, what would you use it for? Right? It allows for people's minds to start to think to themselves, well, what if I took 100,000 of this and did X with it? What would happen? I'm not a real estate coach. I'm not a real estate investor coach. I'm not a life insurance, agent. We don't advise people on what they should do with it. But what we do is we open people's minds to what other people are doing with it as well. This can serve as a good base layer and a good foundation for other strategies as well, because it gives you access to a pool of money in a way you wouldn't have otherwise, your equity in your home, in a way that you're not paying interest to have access to it. And then secondly, it allows for people's minds to start to think like an investor. Even if they choose not to, it gives them the ability to. And I think that's one amazing thing that I've seen with some of our customers, is that their initial goal is to achieve the traditional American dream of, let me just pay off my house. And then I'll see them sort of develop into someone who's thinking more like an investor. Instead of just paying off my house, what if I could accomplish that, but then also get one rental property and create residual income for me and my family, right? They get to ask those types of questions. So again, it's not to deviate from the whole idea of becoming debt-free, because it can sound counter to that, which once we start going down the direction of leveraging this, but that's a reality here too, right? And so what we do at the branch is we have a calculator that will run using people's, we talk about their balance on their home, their income, their expenses, and project a payoff time. And we analyze that compared to what they're looking at right now. We also look heavily on the overall interest cost and what the total cost would be compared to their current total cost. That's our baseline as to whether or not this would be a good fit. There are times where we have to tell people, hey, look, I don't know if this would be a good fit for you. And that's a responsibility that we take on because of our commitment to ensuring that we have a high level of confidence that this is going to help people, not hurt people. So yeah, we sell loans, right? And we, like most loan officers, we have a specific loan program that we sell, but not to anyone. We vet people a good bit. If someone is tracking to a 13-year or longer payoff, that's the conversation we have. Like, I'm not sure this is going to be a good fit. That's our threshold. That's our benchmark. And we had to come up with some number, right? Some arbitrary number, but we do that to ensure that as we help people move forward, that we're doing it in an ethical and in a way that we can stand by the fact that we believe that we're helping people.
Yeah, and you guys have lots of testimonials showing the number of people that have paid off their houses. I want to bring this thing back full circle now, because in the beginning you had mentioned that this is all your bank does. So your bank has become what we consider ourselves is a specialist in industry. And I think, when people are hearing this, they're hearing bank, and first lien HELOC. I mean, could they just go to their traditional bank? And do most traditional banks offer this product like this? And if not, why should they pick your bank and work with you guys versus any other banks? I don't know many banks that do the first lien HELOCs, to be quite honest.
So I think you might be surprised, because a lot of banks do have it. The way I like to think about it is they have it on their menu, right? And it's kind of at the bottom of the menu in the small writing, and their loan officers don't know that it's there a lot of times. And if you do ask for it and they do know that it's there, their next question is, why would you ever want a higher rate mortgage?
Right.
So they have it. A lot of times they will have it, but the feedback that I've gotten and the stories that I've heard from our customers is that the loan officer ends up arguing with them about whether they should get it or not, right? And my answer is, like, I don't care. Like, do you have it or not, right? Do you have it or do you not have it? And tell me about it. But the loan officer wants to pick apart the reason why they'd want it. And then you have someone who has learned about the first lien HELOC, asking, their bank or credit union, who's telling them that, essentially telling him you shouldn't get it, right? And so you won't get that from us. That's one thing. What you'll get is a team of people that know this product. We know the strategy. We know how to teach it. And we know at what point it'll be a good, great, not so good, or really bad fit. And we will honestly tell you that, right? I think that, we have the loan, and we could have taken on an approach where we're going to market this idea and help, everyone get it. But we wanted to go a step further, because the way that people succeed here is they understand how this works, and they control and manage it themselves for their own success. So the only way people are successful is if they understand how it works and they understand how to manage it. So we actually lead with the education piece. That's firstingheloc.com. I know I mentioned this earlier. It's a free educational resource that teaches people about the strategy. We know them really well. I've helped to write some of their content, and they have a calculator on there that people can run to make sure that it'll be a good fit, or to find out, what it would look like for them. So the education piece is extremely important. We also, at least for me personally, and I know my person doesn't really matter that much, but I need to know that my work is helping people. And it was hard to see that with the traditional amortized mortgage route, right? I get to provide someone with a lower rate, or I refinance them, and they say, thank you for helping me get another mortgage. This is one where we get to teach people a new concept, and it's challenging for some people to grasp it. But the better job that we do with teaching them and finding the right people, the more people that we get to improve their lives drastically. And so there's a lot of intrinsic value that comes with that. Another piece to this too is that when it's something that is this important for people's success, we wanted to build a team that we could be sure were complete experts in this. And if we offered VA and conventional loans, and we had a huge diverse portfolio of different products that we offered, we couldn't guarantee that the people on our team were experts. And so here, I can guarantee it. I can. We know this as well or better than anyone else in the country. And I hope that doesn't come across as being arrogant, but I believe it to be a fact. And we can, not only can we help people get the loan, but we can teach it to people. I have an education background. So when it comes to teaching lessons and helping people understand things, hopefully it's a skill set that I've built, and I've helped the team to implement that as well into their calls, their discovery calls. And so in terms of why work with us, we have a team that knows this better than anyone else and can help you figure out whether it's a good fit or not for you, and can help you understand how to manage it going forward. We also built the product specifically for the strategy, and that is different than the other banks that will have it nationwide. The strategy requires you to deposit all of your money in the HELOC. You can't really do that, right? You have to go to a checking first. And then the strategy calls for you to use your HELOC to pay your bills. Well, you can't really do that. You have to use a checking. So what that usually looks like with most HELOCs everywhere else is you deposit to your checking, then you have to log in and move the money from the checking into the HELOC. Well, now all the money's there, which is where you want it to be. It's great, but you've moved the money yourself. And then at that point in time, you need to use your HELOC to pay your bills. Well, you can't do that. So you have to log back in, and you move the money from the HELOC back to your checking just so you can pay your bills, right? Which is fine.
That's a pain in the butt.
It's a pain in the behind. It's a pain in the butt. Look, moving money is not that hard, but moving money for every transaction for the remainder of your loan, 5 years is fast to pay off your mortgage. 5 years is a really, really long time to have to log in and move money for every transaction. Yeah. So we built our Firsting HELOC to take that responsibility off of the borrowers. And so here, when you get your HELOC, you get a checking account as well, and they're connected. We call it integrated checking. And it has a nightly sweep that automates that transfer for you. So here, when you deposit money to the checking, because you need to get the money in the HELOC, all you do is deposit to the checking, which is exactly what you do now. That night, the sweep feature looks at it and sees the positive balance of the checking and pushes all the money into the HELOC for you. And that's how it gets there.
That's awesome.
I can vouch for it. It is awesome. I know I'm a little biased, but it is. And so now all the money's in the HELOC. Well, now you have to use the HELOC to pay your bills. Well, you use the checking just like you do now. And what happens is it does draw that checking balance from zero. Remember, all the money's in the HELOC from zero into the negative. It's not an overdraft. There's no fee. There's no penalty. It's just a reflection of what you spent that day. And that night, the sweep feature sees the negative balance in the checking and just pulls money from the HELOC to reimburse the checking to zero. That just increases your HELOC's balance by the exact amount, essentially paying for those things. So what we've done is we've removed the responsibility of those internal transfers. We've taken that off of the borrower and we've put it on us and automated it. So there's no human error possible because it's an automation that happens. And there's nothing within the product that can get in the way of people's success. So the only thing getting in the way of your success is your budget. And so people ask a lot of times, what's the catch? What's the catch? Well, the catch is it's the borrower, it's the person. That may sound pretty blunt, but it's you, right? If you can manage this in a way that's successful, it'll win. You'll win, right? If you manage it in a way that isn't, then you control that outcome. But in terms of the product itself, we've made it so that your lifestyle doesn't have to change one bit at all. You use a different checking account, but you still deposit to a checking, you still use a checking to pay your bills, and everything else that has to happen all happens in the background.
One of the things that I think just hit me, I knew this, but a lot of what we teach with the infinite banking concept is we teach paying off debt, and we tell people, okay, if you're paying, a line of credit at 8% and it only costs you 5%, like you make the spread in the middle of that. So right. I think one of the things that you could really look at, and this is one of the things that the insurance companies, and if you remember at our last event, we had one of the presidents from the insurance company there, and we were trying to show the difference between the HELOC and the first lien, because the first lien almost is kind of two pieces. It's almost savings and the line of credit. So you could almost argue that your savings is integrated with your line of credit. So the thing I like about that sweep function is every night when that savings in your checking account, that excess sweeps over, it pays the balance of the HELOC down. So if the HELOC's got a rate of 8%, you're effectively on that sweep, that money that goes over there, whatever you paid down, you're effectively making like 8%. I mean, you're recycling. I can't say you're making it. You're technically recapturing 8% that in most cases you would have paid to a bank, but now you're not paying to a bank because of this automated feature. So not only are you getting access to your money, not only is it paying your mortgage off, but you're actually making a better recaptured interest rate on your money than you would because I can't say, the thing that drives me nuts, I did a YouTube video on this today, is we see thousands of people that have a bunch of money sitting in a bank account, a checking or a savings account, making, let's just say, up to 3 or 4% at the absolute highest rate. But then on the other side of their balance sheet, they've got liabilities that they're paying 8, 9, 25% on the credit cards. And they've got the money to pay off the credit cards in their bank, but they won't do it. Number one, because it's a function, it takes effort to do it. But number two, they're like, oh, this is my emergency fund. This is my emergency fund. What if something happens? Well, if something happens, you paid off your credit card, so you have the credit card. You
use your credit card.
It's not the same, but it is, because if they took the money from that bank account that was paying them, let's just say 4%, and paid off a credit card that was charging them 25%, they're making a net recapture rate of 21%. That's their spread. You guys are doing the same thing, just automating that process. You're automating it, and I love that. And people don't think about that. And you didn't really mention that, but I'm just sitting here doing the math. I'm like, holy crap, it's like making whatever the first lien HELOC rate is, 7, 8%. I don't know what they are, but it's the same thing. You're making that because you're not paying that. I mean,
exactly.
There's only one of two things you can do. You're either making it or you're paying it.
Yep. So, and so from a net standpoint, from a bottom line standpoint, and your entrepreneurs are gonna understand this right away, right? People that aren't used to functioning through a P&L or that kind of mindset, you're either making money with your investments or with the things you're borrowing, with the places that you're borrowing, you're paying interest. So if I can choose between making 4% or making 4% with an investment, or if I can choose to offset a liability at 6%. The offsetting of the liability by 6% is the better move because I'm better off by 2%. Yes, I'm saving, we'll call it, or I'm offsetting my interest costs by 6%, but that improves my financial bottom line by 6% instead of improving my financial bottom line by 4%. Mm-hmm. And so now this is a little bit more of a sophisticated model, we'll call it. But now we get into the whole arbitration model, where if you were to borrow $100,000 at 2% to offset or pay down the balance of a first lien HELOC that's costing you 8%, you borrow at 2 to save 8. That's a net gain of 6%. Now we get into sort of that kind of game. Yeah. And so when you're dealing with multiple vehicles that you can borrow from that are liquid, right? The question then becomes, where from a bottom line standpoint, from a numbers standpoint, what's the best place for me to borrow from to offset the balance? I borrow from the lowest cost, entity to pay down the highest cost entity to save the money over here. That's assuming that there are no other things involved, right? The reality is if you're borrowing from two different financial vehicles, even if they're both completely liquid, there may be other qualitative or rules-based attachments that come with borrowing from one that you want to take into consideration. So it's not always a straight one-to-one reality, but assuming that it is, then borrowing from the lower rate one to pay down the higher rate one will always be the better move.
Man, I love that. And now I hope everybody that's been listening to this, you now understand why their product and their specialty is the one you should be using. So let's kind of get to the end of this. How do people reach out to you? How do they learn about this? And how do they get one of these first lien HELOCs? So
the best way to learn about this is check out firstlienheloc.com. It's got there's a how it works page, which is another sort of resource for you to learn more about this, dig in a little bit more. We've got a great YouTube page that has some really great videos as well that you can learn about this as also. And then at firstlienheloc.com, they have a calculator where if you want to see what it would look like if you were to implement this into your lifestyle instead of an amortized mortgage, what would the outcome look like? So firstlienheloc.com, and if you look for the calculator, or if you look for the how it works page, those are great ways to do that. There's also a way to get in touch with one of us and one of the team members, and what we'll do is we'll give you the website for that, so you can click on it. Hopefully below. Chris, does that sound like a good?
Yeah. So just I'll put all this in the description. I'm writing it down now. So firstlienheloc.com. They got the calculator, how it works, and also contact in there. But you're going to give me something else?
I'll give you a link. If this is something that you feel like would be a really great fit for you, and you want to see and want to talk with one of the members of my team, there'll be a link for you to schedule on one of their calendars. It's a round robin. We have 3 loan officers on my team, and it's all that they do. So they'll be able to help you figure out whether it'd be a good fit for you as well, answer your questions, and help you get started if that's what you want to do.
That's great. All right, folks. Well, we're going to put all that in the contact in the description of this podcast episode. So again, firstlienheloc.com. We'll put that there and also give you the link to book a call. But with that being said, Anthony, thank you so much for bringing the knowledge on first lien HELOCs and explaining it. And I love just how the whole thing went full circle. And all of you that are listening, don't get caught up in the teasers and the teaser rates that are not the rate you're actually paying. Get the knowledge you need, learn how to pay off your house, and do it right here, right now. So with that being said, folks, thanks for joining us for another episode of Money School Podcast. We'll see you next time.